In this video demonstration, I'll be walking through the detailed discounted cash flow model for Rost stores. So this will serve as a good example, or at least provide, again, a base level or framework from which you can ask questions during the live session on the walkthrough that I'll perform again. And really want to spend majority of this video demonstration just touching the high points of the model. So as you recall from the simple DCF video demonstration, I went through the rationale for basically using the mid-year discounting convention, and you can see that again here. Exactly the same idea, in essence here, just built out a little bit less time because I've updated it and started my forecasting as of 2016. So in essence here, there's slight differences to this model, but not huge differences. Again, you can see here there's a little more detail in regards to in the simple DCF. I had no PAT plus depreciation less CapEx give me free cash flow to firm. In this case, I've added that change in working capital. So that's a new wrinkle to the detailed DCF model that I thought I would highlight in the DCF tab. You can see here that I have the same discount rate, terminal growth rate assumptions, implied multiple, and reinvestment rates yet again. The interim summation of free cash flows to the firm, as well as the terminal. And you can see here too, I've actually broken out that in essence, 25%, well, something on the order of like 20 to 30% of valuation comes from the interim cash flows, and actually, something more in the order of 70 to 80% typically comes from your terminal cash flows. Here you can see I just sum up the interim plus terminal cash flows, back off the debt, in order to arrive at the free cash flow that's available to the equity holders divided by shares outstanding, and arrive at my estimate of IV. So that's the mechanics of the DCF tab, and from here I'll move forward. If we take a look at the beta calculation, it's rather complex, and again, this information comes from the Kenneth French website, the data tab, US returns. In essence, what we can do here is unpack, basically the key column here is column B, market minus risk-free rate, gives us the return profile for the general market, broad market, less the risk-free rate, which is, again, typically the 10-year US Treasury bond. You can see here I pulled this information in columns G through, let's see, M from Yahoo Finance. And again, calculated an excess return using the natural log function to calculate a return there, and then basically took the Rost return and subtracted off the risk-free rate in order to arrive at a Rost's excess return. Because we have the market excess return here, right? We need to adjust the Rost return for that risk-free rate as well. I basically did the covariance, or you could run a regression as well. The covariance of the two data series here divided by the variance of X, or the excess market return, gives us the beta for Rost. We could also take, again, the correlation divided by standard deviation of Y divided by X rather. And again, we can arrive at basically the same solution. So again, a cross check here. You could also, again, use the data analysis toolpack to run regression on the excess return of Rost over the risk rate versus the excess return on the market. This tab basically calculates WACC. In essence, I went to the FINRA website, and again, I'll provide the links here. In some cases, the sources are at the bottom here. And I basically just took that 3.375 or 3 3/8%, applied a tax rate to it to establish an after-tax cost of debt. Now, because debt was such a small percentage of the overall capitalization of the company, right, it's not going to have much of an impact on a weighted average basis to the overall WACC calculation. In fact, most 98.7% is going to be the cost of equity, or the equity component. So on to that piece there, you can see that I pulled the risk-free rate, which again, just using the 10-year Treasury. I pulled the equity risk premium, which comes from Professor Demoteran's site. You can grab that right off of the front page as you land on the Demoteran site. you'll see the equity risk premium that's calculated or estimated rather, and then simply perform the CAPM equation, which is unpacked down here below. Basically, risk-free rate plus beta times the equity risk premium. So that gives us 7.7%, which is how we arrive at a cost of equity of 7.59% and a WACC of 7.6%, which if you go back to the DCF tab, you can see I'm using the 7.6. Okay. Moving right along, there's a lot of different ways, as I mentioned in the pro forma lecture, as to how to calculate or estimate the future growth rate. But one way that's relatively simple, especially for retail, is just to use the future store growth assumptions. And so from there, in the same vein as volume times price, right, to arrive at a sales growth rate or what have you, we could also use stores times sales per store, so to speak. So in essence, lots of ways to use the volume and price drivers to get to a solution here. And you can see that typically management teams will lay out the store growth assumptions going forward. So in essence, you at least have 1 year of information, and then going forward, they will say sometimes too, like what the saturation point for the total store base, in this case Ross and Dd's, would be. So 2,500. Again, I'm only estimating out 5 years, and I kind of take a look, do a face validity check of how many stores do they build each year, and geez, are my assumptions getting a little bit ambitious, so to speak? And that does appear to be the case from the standpoint that if you take a look at this, it's within the range of probability, right? And that I don't ever exceed the maximum number of stores built in a year, but it is a stretch probably to say, well, 80, 90 stores a year, especially as you get further and further built out, it just gets harder and harder to find good locations. But I digress. This is the store growth tab. And I'll kind of skip over the comparable store sales because most of that's historical comparable store sales. But of course, I estimate out future, what would a good DCF model be without having some future assumptions plugged in there. But I want to make sure that I cover all the different tabs here so that, again, you can come with questions on Saturday if you have them. From here, I basically did a quick scenario analysis, and you can see here that, well, it should be changing. It is changing the assumptions there on the sales growth front as well as the op margin. But basically, all I'm doing is a VLOOKUP or index match to basically look up the values, and those drivers then change the financial statement tab, which you can see here that these are linked to the key drivers tab. So very similar to the simple DCF model. The only difference being is that I'm basically toggling the key drivers on a separate tab here. And again, it's a little more detailed, but the same idea holds in that I'm using the same rationale as outlined in the pro forma lecture to think about what the base, bad, and good scenarios may be. Okay? So moving right along to the FS tab, the financial statements tab, you can see here the 3 key financial statements. We keep coming back to that concept over and over again. So in essence, we've got our income statement here, balance sheet, and statement of cash flows. And we'll just start at the top here, dealing primarily again with the future only. All this other information will come from the sec.gov. So you can basically download those financial statements, kind of clean them up and put them in a format that's usable, and that's what I did here. I also added some additional information, which you may or may not want to do. If you want to add that additional detail, that's up to you and your group. But this is other pertinent information that you could use for the Ollie's case. Okay, so here you can see the formula is just as simple as the simple DCF model in that I'm just taking current year times 1 plus the growth rate to arrive at my absolute sales dollar level. Okay, I skip estimating gross profit and selling general administrative expenses. I used to do that, but in essence found that additional detail not terribly helpful, and so in essence just went straight to estimating EBIT or the operating profit line in order to, again, simplify the model as much as I could. If you look here, it just, again, is just sales times your operating margin. So again, sales is the key driver and will be the key driver to most, if not all, models. In fact, in interviewing one of the best hedge fund managers I've ever met, basically said the same, is that if you can get sales right, a lot of other things fall in place. And that I found in my career to be patently true advice. From there, I take the interest expense, which is basically just my debt times the projected interest rate, or the interest rate on the face of the bond, the 2024 bond that I outlined in the WACC calculation tab, to arrive at a profit before tax, or a net income before tax. I apply a tax rate, which I think if you go back and look at the tax rate here, I've sort of estimated 24% for the next 3 years. And then, to be completely apolitical, I said, hey, I'm not exactly sure what happens post 2020. So, I mean, in essence, it's somewhere between 24, 25, and 35%, which it was previously. And I think that's the best way, to kind of keep your estimates and model as, I guess, like agnostic as possible as far as prognosticating many, many different things, macroeconomic, geopolitical, etc. And from there, you can see I just, simply calculate net income by subtracting the tax. I'll let you walk through the supplemental parts there, but note Pat, is very important. As we go down a bit further to the balance sheet, this is where things get a bit more complicated, but again, stick with me here. If you take like the cash we learned in the module, the accounting module, that the cash flow statement is the bridge, and essentially that's where the cash balance is coming from, is the ending cash of the cash flow statement, okay? The change in working capital here, the current asset rather, is a calculation driven off of sales. So it's like current assets times a certain percentage times sales gives me my current asset value. And when I add cash to my current asset value, I get the total current assets in essence. Okay. Property, plant, and equipment is simply taking previous year's property, plant, and equipment. So that's net PP&E. And we're basically just adding CapEx, because again, while capital expenditures are reductive to overall cash flow, right, it is an asset. In essence, we're just adding it to we're basically taking a liquid asset, which is cash, and purchasing a non-liquid, or more of a long-term asset with that cash. So in essence here, the PP&E net is growing by the CapEx amount. And in this case, depreciation, or rather accumulated depreciation, is growing by the depreciation charge that we're taking each period. These other accounts are basically highlighted in red because I'm just hard coding or keeping them consistent throughout the forecast period. There's not really any good way to estimate these, and so that's why just leaving them static I found to be the best route. Total asset calculation, very simple, just current assets plus all your non-current assets. And accounts payable, same with the current assets. I'm taking a certain percentage times the sales amount to arrive at a current liabilities figure. Similar to what we explained above with other non-current assets, I'm setting these, I'm locking these to previous years. In the case of debt, you will see though that I'm actually adding, or rather subtracting in cases where it's repaid, the value from the cash flow statement. So again, we'll get down to that in a bit here, but that should explain that. And then for equity, basically taking equity from last year, adding net income, and then taking the sum of any dividend payments or share repurchases, because those will be reductive to the overall equity balance, to arrive at total equity, and then adding total equity to total liabilities to arrive at our balance here. And the check basically is just saying, do the assets equal the liabilities plus equity in this case? Yes, so hooray. And now onto the cash flow statement. Okay, so the cash flow statement pulls from, again, the net income statement as well as the balance sheet items. And you can see here, these first two items are pulled directly from the income statement. The depreciation is an estimate, and the change in working capital is a calculation. You can see basically taking this information here and again estimating current assets, current liabilities as a percentage of sales. You can walk through these calculations to see exactly how I calculated that change in working cap, X cash, and short-term debt. But in essence, that's the figure there to arrive at a cash flow from operations. And then the CapEx, again, assumption as a percentage of sales, and that gives me my cash flow from investing. I didn't want to make things more complicated than they have to be, so I'm not going to include potential acquisitions and other items. And then here is where things get a little bit tricky in that basically I've computed like the dividend paid is a key driver. And then this came from management guidance. But you can see here that there's a circular reference. And in essence, this line is the plug, right? The stock repurchase is a plug line. So in essence, in the model, if you click here, you can see that there's like a warning, if you will. And it's just saying, you know, you have circular references. Yeah, you want to enable those in iterative calculations when you're opening the spreadsheet, press OK, and it goes away. Okay. And with any luck, as long as things are still working out, you can still have a check balance on your assets equaling liabilities plus equity. But again, if there's going to be questions, I would expect most of them to come around this plug. But in essence, something has to be the plug, and sometimes it's going to be debt. In the case of Rost, they don't have much debt, so I chose stock repurchases as the plug value here. And you can see that each year, subsequently, they're taking the cash they generate, and I'm having them repurchase stock at an increasing rate as to hold the cash balance at a more, you know, sort of reasonable level. Okay. So from here, we can get the net change in cash by adding all those items. And you can see just basically taking the beginning cash plus the change in cash to get my ending cash. And as we mentioned before, these ending cash balances are what flow back up to the balance sheet and the cash balance there. Okay. Cash taxes paid, simply just taking a view that, again, like sales, or rather profit before tax times a specific tax rate, whether that's 35, 24, 24, 24, 30, 30, that's how that's computed. And supplemental information, yeah, I mean, I'll let you kind of work through that. The ratio tab is pretty interesting from the standpoint that we'll be utilizing those skills acquired in the second module again. And some of these metrics, right, particularly the store metrics and other ones that are more germane to retail, I don't expect you to have those, but do please, you know, review this tab and go through the different profitability, leverage ratios, etc., that we covered in Module 2 and include those in your Ollie's model. CE is simply consensus estimates. Probably beyond the scope of this course, so I wouldn't really worry about it too much, but in essence, it's a cross-check as to what do my estimates look like versus the street or Wall Street's estimates of the future, right? And then the lease terms. This is debt, essentially, but not debt that's included in the balance sheet, at least not as of 2018. So again, probably a little bit beyond the scope of the course, but I did include in my detail model. In the beginning, you'll see the summary model, which will look very similar to the L Brands summary model. But in essence, that is, again, in a short, almost 18, 20 minutes, short walkthrough of a detailed DCF model. And I do expect you to have questions. So again, feel free to reach out anytime via email. And I can set up a time to chat telephonically, or maybe we can do a live meetup online or what have you. But definitely am very passionate about valuation. Spent a decade of my life in models like this, and so therefore, you know, want to do what I can to help you along in understanding the detailed discounted cash flow model. Thanks for your attention. Thanks for sticking with me, and I'll see you on Saturday.